Hello everyone, my name is Roger Conrad. I'm the founder and chief analyst of Conrad's Utility Investor. First, I'd like to welcome you to this brief video where I'll be talking about a simple investing system I've followed for more than 30 years for my clients as well as for my personal portfolio. Over that time, we've earned more than twice the annual income of the typical stock and bond account. We've also captured average annual returns upwards of 13%, as tracked by major advisory rating services, and all from a group of stocks that's now flying under the radar at their fastest rates of growth in more than 60 years. I'm talking about utilities, telecoms, and other essential services sectors. My advisory, Conrad's Utility Investor, tracks over 200 of these companies, many of which I've followed for more than 3 decades. That's at least 25 years longer than any of my competitors in the investment advisory business. Since mid-November 2017, the average utility stock has fallen by more than 20%. But months before, I began warning investors that record high sector prices and valuations were unsustainable. And parts 1 and 2 of my 3-part strategy have already paid off in spades for investors, unloading the weak and taking partial profits on the highest flyers in order to build cash to invest on the inevitable pullback. Now that we've had that pullback, it's time to step up to the plate. And I've highlighted the 2 best buys in my March issue of Conrad's Utility Investor. The 2 cheapest stocks in the Dow Jones Utility Average, both on track for near 10% growth in their 5% plus dividends and trading for barely 10 times earnings. Before I tell you about these and other emerging bargains from the utility stock sell-off, let's look at something even more important. I don't point these things out to crow about past forecasts, just to demonstrate that in stock market investing, nothing is more valuable than experience, having been through it all before. I want to show you a graph. It tracks the performance of the Dow Jones Utility Average since January 27th, 1986. That's the day I started in this business, tracking and recommending utility stocks. When you look at this graph, you'll probably be tempted to say anyone could have made a great deal of money simply buying the stocks in the DJUA in January 1986 and holding on. And you'd be right, but with a few caveats. This was before the era of exchange-traded funds, so you would have had to make more than a few adjustments in your holdings to match the index. As recently as September 2014, for example, American Water Works replaced Williams Companies. And don't forget Enron was a DJUA member at one point too. Also take a good look at some of those jagged ups and downs in the graph. Each of those waterfall drops was an invitation to abandon even the most steadfast of utility stocks. And any imperfect re-entry would have doomed investors to underperformance on the recovery. It might surprise many of you to know that the catalyst for these big declines was never rising interest rates. In fact, benchmark rates were actually falling at the time of what are by far the 2 biggest drops on this graph. That's the period from early 2001 through late 2002, and the period from mid-2008 through early 2009. Meanwhile, the steepest part of that big recovery you see from late 2002 to early 2008 happened at the same time the U.S. Federal Reserve was raising the Fed funds rate from 1% to 5.25%. That's not really what you're hearing now in the popular investment media now, is it? Of course, there are some examples in this graph where worries about rising interest rates were blamed for selling of utilities and dividend-paying stocks in general. But the real catalyst was always something more powerful. From late 1993 to the end of 1994, for example, interest rates were rising. But it was the threat of industry deregulation and competition, forcing utilities to write off billions of dollars in so-called stranded costs that took down the sector. When companies began proving they weren't such easy marks, utilities went on to rally hard for 6 more years. Similarly, the utility sell-off that started in mid-November has also been blamed on the threat of rising interest rates. But the real catalyst was simply the off-the-chart expectations that were on display in measures of standard valuation that had reached unprecedented levels, from PEs to dividend yields. From these lofty heights, almost any disappointment was enough to trigger selling of utility stocks, and in November, investors were confronted with several at the same time, notably the popular misconception that utilities had fared poorly under U.S. corporate tax reform and overblown concerns tax cuts are inflationary. It's said that big and fast declines are always bullish because they deflate market excesses, and after 3 months plus drop, utility stock valuations have normalized along with expectations. Meanwhile, company after company we track has increased its long-term guidance for earnings and dividend growth. Let me show you another graph. This one covers the last 25 years, and it compares rolling returns for the Dow Jones Utility Average, the S&P 500 Index, and the TNX, which is the yield on 10-year U.S. Treasury bonds. The red and white lines basically overlay each other, though sometimes they diverge, as they clearly have in recent months. Also, the white line, which tracks the rolling return on the DJUA, owes much of its upside to dividends rather than capital gains. But over this long period of time, returns for the DJUA and the S&P 500 basically tracked each other, and with no real correlation to what was happening with the yellow line, the TNX. The lesson here is utilities are stocks, not bonds. While the Pavlovian response of some investors to interest rate volatility may cause them to rise or fall from time to time, sector returns follow company earnings growth, just like every other stock. The good news for our favorites and the 200-plus utilities in our Conrad's Utility Investor Coverage universe is those earnings are now rising at their fastest rate in more than 60 years. The key is capital spending. Utilities are doing more of that now than at any time since the last building cycle in the 50s, 60s, and 70s. The difference is the money is no longer going to the kind of big power plant projects that are at risk to running billions over budget and suffering equally large write-offs. They're smaller scale projects that companies have long histories of being able to complete on time and under budget. They're natural gas power plants that can be run far more cheaply and efficiently, as well as cleanly, than aging coal and nuclear facilities. They're distribution and transmission system infrastructure replacements and upgrades that improve efficiency and cut operating costs. They're renewable energy and energy storage projects that enjoy robust support from state and local residents, businesses, and governments. They're data system upgrades with the potential to shave billions more in operating costs over the next 5 to 10 years. And all of them add to earnings within months of when an investment is made. Management teams were already guiding to upper single-digit annual rate-based growth last year. Now, with companies passing lower corporate tax rates through to customers, there's even more room for passing through investment to spur growth. That's another feature of tax reform that's not reported in the popular investment press, but it will start showing up this year in the earnings of the kind of best-in-class utilities we recommend. And shortly after, that's going to show up in higher share prices as well. I got an early jump on this trend by attending the Edison Electric Institute's 52nd Annual Financial Conference this past November. And as I do every year, I shared my findings with Conrad's Utility Investor readers in my special audio-visual report, Top Takeaways and Best Ideas from the Edison Electric Institute's 2017 Financial Conference. My picks from the 2016 conference outperformed the DJUA over the next 12 months by nearly a 3-to-1 margin with a more than 30% average return. This year's picks have so far faced a much more difficult market for utility stocks, but they're already outperforming the DJUA by 8 percentage points, and they're beating the poor PANs in the report by double digits. Attending EEI and other industry events is critical to gaining insight that's impossible to glean reading a press release or listening into a conference call. And the access adds up to a huge edge for Conrad's Utility Investor readers over the competition. In fact, it's a giant step for me personally as an advisor over my work at my former publisher. Getting out and about has also been invaluable refining my 5-point quality grade system, which rates the 200-plus coverage universe companies on a scale of A to F. This system is as qualitative as it is quantitative. We don't rely on single numbers. We use multiple metrics to calculate each point to get the clearest and most accurate lead on payout sustainability, revenue reliability, regulatory risk, refinancing risk, and operating efficiency. Each company's rating is therefore the result of hours of research that builds on years of familiarity and experience. We then take those quality grades and benchmark them against valuation and growth criteria, and the results are our buy, hold, or sell ratings. It comes as a surprise to many new readers that not every A-rated company will rate a buy when they pick up their first issue. As all too many investors have found out since November, even the highest quality company can suffer a big fall in its share price if its stock has flown too close to the sun. Picking the right entry points is just as important as correctly gauging potential risk and reward. And that's never as true as when a bull market in stocks is aging, as this one certainly is from its origins in March 2009. November was a dangerous time to buy utility sector stocks, as we warned investors that month. Conversely, we've headlined our March issue as, quote, opportunity knocks, as a number of first-rate companies have dropped to our value-based buy targets and below. Of course, not everything is as yet a buy. In fact, roughly 1 in 6 companies in our coverage universe still rate a sell. Some, even though they've lost quite a bit of ground since November. The most important to sell now are those that are also on our endangered dividends list. The EDL is our early warning system for readers to avoid companies at risk of cutting dividends before they make their move. Hopefully you've never owned a company that's cut its dividend. I certainly cannot make that claim, but my EDL has saved a lot of investors a lot of pain. Take the 2 longtime sell recommendations from our coverage universe that cut payouts last month, Frontier Communications and NuStar Energy Partners. They're down an average of 70% over the past year, including a final plunge after cutting. Unfortunately, market history shows pretty clearly that there will be more dividend cuts, even in the utility sector, as this bull market ages and inevitably someday becomes a bear market. That means the endangered dividends list is going to become more important than ever for all of us. So, where can you find safe, high-yielding, and reliably growing dividend-paying stocks? As a matter of fact, after the recent market sell-off, there are nearly 90 companies in our utility report card coverage universe that rate a buy. That's based on our quality grade selection process matched against valuation and growth metrics. That includes more than 30 companies between our 3 model portfolios, conservative, aggressive, and top 10 DRIPs, or dividend reinvestment plans. The conservative holdings are suitable for even the most risk-averse investors who want high and safe income yields of up to 9% with the expectation of upper single-digit annual growth in principal. The aggressive holdings feature some yields as high as 11% and potential growth several times that, but with the caveat that the companies do face challenges that we're betting they'll overcome. The goal of the top 10 DRIPS portfolio is long-term wealth compounding. We do this by reinvesting the rising dividends of best-in-class companies every quarter in additional shares of stock. Every year we buy a greater number of shares as dividends are increased and our holdings grow. This is the strategy I've personally followed for more than 30 years. And let me tell you, it's coming in mighty handy now funding the college education of my 3 millennials. I probably don't have to show you this picture of what the power of wealth compounding can do for you as an estate building strategy, but if anything, it understates what's possible pretty dramatically. My holdings of Dominion Energy, for example, rose nearly 20 times what I bought my original shares for from a company plan encouraging its Virginia utility customers to become shareholders. One reason for the understatement is that the green line assumes a constant 8% dividend reinvested. Dominion has guided to 10% annual dividend growth the next few years. Another best-in-class utility, NextEra Energy, is guiding to 12 to 15% a year. Those growth rates are incidentally several percentage points higher than what's forecast for the S&P 500. And they're backed by big, strong, regulated companies that have proven they can keep growing even during a recession. Portfolio companies are the cream of the crop of our coverage universe. But every utility report card company gets just as much analysis and research as portfolio companies do. After all, they're basically our watch list. That's where we draw our new buys from. One of the hardest lessons for me early in my career was when to sell. I still believe in buy and hold for at least a good piece of your portfolio. You're simply not going to do better than our picks for high, safe, and growing dividend yields, and that's critical for anyone who lives off their investments. But it does make sense to take money off the table when a big winner enters the stratosphere, with the idea of buying back in later at a lower price. Think of the difference between a high flyer's price and where it would rate a good buy in terms of quarters of dividends. How many quarters of dividends would it take to make up for a drop back to our buy target? If it's more than 15, it's going to make sense to sell some, put it into an accessible cash account, and come back in when prices have come lower. Again, that's not conventional income investing advice. You're not going to find its ilk from our competitors or even on Wall Street, but you will find it at Conrad's Utility Investor. Just ask our readers who've been able to book huge gains and then come back in to stocks like CMS Energy and Pembina Pipeline. Before I close, I promised you a stock recommendation. And if there's one thing I pride us on at CUI, it's when I tell you something, I always follow through. Like our pledge to never raise the price of your subscription so long as you're a paid subscriber in good standing. My recommendation for you is AES Corp, New York Stock Exchange symbol AES. The stock's valuation of just 9 times expected 2018 earnings is not only the lowest in the utility sector, barely half the DJUA's 17.5 times. Not only does its yield of nearly 5% compare with just 3.6% for the DJUA and 1.8% for the S&P 500, its locked-in 8% plus dividend growth rate is also more than 2 percentage points higher than both the DJUA and the S&P 500. Why the discount? Because AES suffers under a case of mistaken identity that's hard to shake. That it's still a financially weak owner of an ungainly power plant portfolio straddling some of the world's least hospitable regulatory environments. The reality is this company has streamlined away risk, slashed debt to the point where it will achieve investment-grade credit metrics next year, and built a leading position in solar power and energy storage, already the fastest-growing sources of electricity and set to be so for the next decade. AES is truly a one-of-a-kind company, selling at the kind of bargain price that only appears once a generation if you're lucky. It's one of my top picks for the year ahead. In fact, it's the top performing company in the DJUA year to date, topping the sector average by 10 percentage points so far. And it's my gift to you for listening to this video. It's my sincere hope that you'll check out the risk-free offer below to see more stocks like AES Corp, including weekly macro and micro commentary, alerts, quarterly chats, and conference reports, in addition to your regularly monthly issues. With full access to our site, you'll be able to peruse our 200 company plus utility report card, the current endangered dividends list, our 3 model portfolios, and every back issue and special report since the first issue of Conrad's Utility Investor back in 2013. I'm proud of the work we've done and excited about the opportunities ahead. Thank you again for your kind attention.